Welcome, everyone. Thank you for attending today's webinar about strategies for today's high and uncertain markets. My name is Greg Shaughnessy, and I'll be your moderator. Before we get started, please take a moment to read the disclaimer on the screen. Today's presenters are Tom Hamlin, CEO of Somerset Securities, Inc. and Somerset Wealth Strategies, LLC, and Ryan Ashby of Athene Life and Annuity. Following the presentation, we'll have a live Q&A session, so please submit your questions. At this point, I think we're ready to get started. Tom, take it away.
Thank you, Greg. Good morning and good afternoon, everyone. Thank you for joining us here today on our webinar. I wanted to share with you what we believe to be three, if not the three top annuities today, certainly for our lineup. Right now, there's just a tremendous amount of uncertainty out there in terms of what to do in the investment world. Stock markets are at an all-time high, with the exception of course, September. It's been a rough month, which is another reason to have this webinar and why it's so timely. Bond markets are at all-time highs, meaning that yields are at all-time lows. Interest rates, yields are at all-time lows. Real estate is at all-time highs, and there's a lot of near-term, if not intermediate-term, if not long-term uncertainty. Inflation has been on the rise. We are looking at let's see, May, June, July, August, 4 straight months of 5% or greater inflation. We'll see how September looks, but I would imagine that it's in that area, could even be slightly higher. And so there's a lot of uncertainty with regard to, what do you do? Where do you invest your money? How do you protect yourself against all of this uncertainty? We've got a tremendous amount of obstacles to overcome in the days, weeks, months, and years to come. By investing in what we're going to cover today, you're going to be able to protect your downside. You're going to be able to participate in the upside, and you're going to be able to have the peace of mind that anyone would need when you're entering anywhere close to retirement. Once you're within 10 years of your retirement date, your target date, you really need to start thinking about, okay, how do I protect what I've worked for the past 20, 30, 40 plus years as I enter retirement? Retirement's no longer 4 years, which is what it used to be. There are people that are living 20, 30 plus years in retirement. So you really need to not only be able to protect your downside, but you also need to be able to have a hedge against inflation. Having your money in cash or in a 0.7 or 0.6% CD, just had a client last week contacted me last moment, and his CD that was 2.6 last year with Synchrony renewed him at 0.65 on a sizable amount of money, over $350,000. He called me on the last day before it renewed, and fortunately we'd opened up what we're going to go into in a little bit, one of the products that we'd previously covered the day before he turned 80, so he was able to get involved in that and add this money that would have renewed at 0.6. So we're going to talk about give you some great strategies on how to protect your downside and how to have a hedge against inflation and how to have peace of mind so that you could sleep well at night through financial independence. So with that, we're going to go into our first product, which is Athene Amplify. If you've been in touch with our company over the last couple of years, you certainly have heard about this product. And it's a great way to participate in the S&P 500. I'm not going to spoil it. I'm going to bring on Ryan Ashby, our incredible wholesaler with Athene, and he's been with us for several years, which means he's been with them for several years. He knows these products forward and backward. And with that, I'll introduce Ryan Ashby. Ryan, welcome, good morning, and thank you for joining us here at Somerset on our webinar. So thanks for being here.
Fantastic. Thank you so much, Tom. And Thank you, everyone, for joining us today. I think one of the things that I look at when I see the scenario that we run ourselves into is how can we get the upside of the market but protect ourselves from the downside. We have everything from the S&P 500, we have the Russell 2000, which is the small caps, we have the EFA, which is the international. We have a way to put them all together as well. But the one I really want to focus on is the S&P 500 with a 6-year point-to-point. The benefit of Amplify being technically a variable product, a registered product, is you have interim values. And what that means is if it's up today, you're going to see that in your account. If it's up over the next month, over the next 2 months, you're going to see that in your account. That's real value that you can walk away from if you so choose. I'm going to use an example here of that interim value and how it works. My father-in-law went in March 22nd March 8th of last year of 2020. 12 months later, on March 22nd of this year, his $100,000 was sitting at $167,000. That was interim value. That was real money. Could have walked away with $159,000. The reason why this is so important is because we're seeing this market going up, and the rest of the market is trying to follow along. But when you look at where the trends are going, the total annuity market, as you can see on the slide, is up 39% year over year. Index annuities are up 28%. Your traditional variable annuities are up 55%. But yet, when you look at the registered index market, the registered index linked annuity market, it's up 124%. Now, some of you may not be familiar with this space. The space was created in 2014. It's only been around for 7 years, and this year it will do more than $29 billion in total sales, and yet did not exist just 7 years ago for all intents and purposes. There's now a lot more competition in the space, but where we separate ourselves from the competition is we have this 135% participation. And where that comes in, it really looks at it from what are clients, returns actually doing, and what are you going to do in Amplify? As you can see in the slide, on this slide, the average return for an individual investor over the last many, many years, the Dalbar study has been going on since the mid 80s when they did the look back. On the last 20 years annualized, individual investors average 2.9%. Where this information comes from is when you're doing it inside of your 401k. You're managing it on your own. A lot of times people are just buying and selling the S&P 500, buying large cap mutual funds in their 401k. And yet people a lot of times make bad decisions when left to themselves. What we're doing and what the S&P is doing, as you can see, the S&P is 7.5%, almost 2.5 times what the average investor did. At 7.5%, if you do the math on that, at 135%, you're close to 10.5 as an average annual return. Greg, can you go to the next slide, please? Because this is where really the rubber meets the road, so to speak. And I think it really comes to that, like I mentioned, the 135%. We look at the 6-year rolling periods, and the 6-year rolling periods since 1980 have averaged 74.3%. That's the average return if you take every single 6-year day to day, not month to month or year to year, but actual day to day. 6-year average is 74.3%. At 135% participation with no cap, that's 100.3% return with the fee or plus the fee. The 77.6%, that's the median. So Half of the rolling 6-year periods are above that, half are below that of 77.6. That would be 104.76. Now, if we start to look at it kind of from a more near term, when you look at January 1st of 2015 through December 31st of 2020, that return on the S&P 500 was 82.49. That number gets you north of 120% return over that time period. And when you look at it, not having a cap is kind of the biggest benefit. When you have a time period, imagine going into 2009 at the bottom of the market. Imagine what that next 6-year period looked like. That S&P was up 249%. You would be getting 135%. Now, I'm not saying that scenario is ever going to happen again, but that's the kind of what if type scenario. So now you're thinking, well, what's my downside protection? The downside protection here on the 6-year period is a 20% buffer where Athene will eat the first 20% of any losses over that 6-year period. So at the end of 6 years, if it's down, the S&P is down 10%, you will have incurred no losses in that period due to the index returns. One of the big benefits that we see here with that 20% is the worst rolling 6-year period the S&P has ever had was 18.49. So the S&P has never punched through the 20%. Again, not saying it could never happen, but we will eat the first 20%. So when you go back and you see, okay, now I'm starting to understand why this space is up 124% year over year. It's because clients want the benefit of the S&P going up without incurring the losses going down. As you can see on the slide, if the S&P was up 67.5%, you're looking at a 202.5% return there, or 67.5 on a 50%. If it's up 150, you're looking at a 202.5% return. And it would be fantastic to have a 200% return over 6 years. That would be 270. If you think about it from, it's sitting in my Fidelity account, it's sitting in my Vanguard account, it's sitting in my Schwab account in the S&P, in an index in a SPDR ETF as an example. If it was up 50, you're getting 50. If it's up 150, you're getting 150. And we aren't capping you out. One of the things that's been pointed out over the years is, when we look at dividends in the S&P 500, years ago was significant. Today, you're looking at less than 1.5%, getting close to that 1% mark. And who knows, as more and more non-dividend payers are entering the S&P and taking up a much larger percentage of the index, that index yield is going to continue to fall and will become less and less of an issue. Yeah.
What other slides do we have there, Greg? Is there another one for Amplify? What's the next slide?
I think this might be the last one. Yep.
Okay, go back. Okay. So just to dovetail off of what Ryan's sharing with you, it's incredibly difficult to beat the S&P 500. Really good luck over short, intermediate, and long periods. About 98, 99% of professional managers, mutual fund managers, ETFs, you name it, have failed to outperform the S&P 500. That's why John Bogle of Vanguard, who founded it as a nonprofit back in the 70s, has experienced tremendous success when he had indifferences with his colleagues at State Street Funds in Boston, and they believed that it was active management, and John believed that it was passive management, and that's really what popularized the S&P 500 as a place to invest. In other words, just throw darts at the dartboard, and you're actually going to do as well as the pros. So when you everybody that wants to have a hedge against inflation that can tolerate the risk involved with investing in the S&P 500 or any equity program, risk goes down over time, but in the near term, flip a coin, you have a 50% chance of losing over a 12-month period, but over a 10-year period, that risk goes down to less than 1%, or actually was 2 when you factored in the 08-09. So less than 2% at this point in time. In this particular program with 135% participation rate, the way that you view it, if the S&P is up 10, and then you multiply that by 1.35, that's 13.5 minus out 95 basis points for that fee that Ryan's referring to, you end up netting 12.55%. And that 12.55, you have to understand that 95 basis points is based on your original investment. If you put in $100,000 and the market was on a trajectory to double over a 6-year period, well, that fee doesn't average 95 basis points. It averages about 60 to 70 basis points over that time period. And furthermore, it gives you the peace of mind. Oh, by the way, with the 95 basis points, they're not putting that in their coffers and lining their pockets with it, and they're certainly not sending it to us. They're using that to turbocharge the return. That's why it's greater than 100% participation in the S&P 500. So, again, 98 to 99% of professional managers fail to outperform the S&P 500, yet here's a way to participate and receive 135% of that minus an average of about, depends on how the market does, but a maximum, let's say, a 0.95. Going back 41 years, Ryan had sent me some great information in the past. You look back to 1980, you take the close of 12/31/1979, you look forward all the way to present day, you're looking at, if you take the first 6 years, it'll be January 1st of 80 through the end of 85, that's 1 6-year period. Drop the first day in 1980, add the next day in 1986, that's 2 6-year periods. Climb all the way through every single daily close through the end of last year, you're looking at about 13,000 6-year closing periods. About 10%, a little north of that, people lost, if they were in the S&P 500, exclusive of dividends, not inclusive, exclusive. And this product is exclusive of that. But Ryan already told you that those fees or those dividends aren't 3% anymore. There were people that said in the past, if the dividends drop below 3% on the S&P 500, you need to get out. Okay, you need to sell. And but we're not in the same times that we were in the 80s and 90s and even the 2000s. The trend is dividends down. They're dropping companies that had dividends, and they're bringing on companies like Salesforce and Tesla and others that don't issue dividends, okay? And then on top of that, you have a lot of companies that were known for their dividends. General Electric had never even lowered a dividend, much less stopped it, okay? Ford had a 10% dividend plus before they stopped it, okay? So the point is that those dividends through August average 1.31%. So you're not giving up a ton there. And the trend, I believe, is going to be further down. If we see a big correction in the market, 20% or so, well, then your dividend's going to increase. Congratulations, your dividend went up a little bit, but your portfolio is 20% lighter. It doesn't make you feel good. It's not a warm and fuzzy feeling. And in this product, you'd have 20% downside protection. That is amazing. When you're down, when the market's down 25, you're down 5. And by the way, over those 13,000 6-year closing periods, where over 1,300 of them you would have lost in the real world. But in this program, those, the worst 6-year period, minus 18.4. This product gives you 20% downside protection. Now, factoring in the fee, you would have been down a little bit, but you wouldn't have been down 18.4. So this is a phenomenal product. It's a phenomenal way to protect your downside because the market is at an all-time high with the exception of September, and this is a great way to give you some peace of mind to enter the market when you might normally otherwise not, and have that downside protection, give you a little bit of courage, like getting into a boxing ring with Evander Holyfield, somebody who was great back in the day, with a bunch of padding on. You're going to be a little less fearful than you would if you had to face him straight on, okay? So without the protection. So anyway, this product is our favorite way to be fully and truly invested in the greatest index in the world, in my opinion. I believe in this country. I believe that we're about to hit some big sovereign debt crisis, and their banks overseas are not in the shape of our banks. And I think the flight to quality, instead of being to treasuries, which at least ours are paying a positive number as opposed to the Europeans, which are at a negative number, at least the Germans, the one that you can trust to make the payments on those bonds. They've been in the hole for 8 years trying to dig out, and things are tougher now. Well, I don't think the flight to quality is in treasuries. I think the flight to quality is in our S&P 500. I believe that that's the flight to quality play for our country. And just in case we're wrong, I'm wrong. Well, we've got 20% downside protection. We're going to beat the S&P on the way up. We're going to protect you, and it's going to beat the S&P on the way down. And you're not married to this thing. You're in it for 6 years. That's the term. But, you know, worst comes to worst, market's down 20%. You can pay a 7% penalty and get out. There may or may not be an interest rate adjustment on that, depending upon the options and the bonds that are backing it. But there's arbitrage in there of 13%. We'll see how that holds up when the market goes down. But I can tell you what, if you hold it for the 6-year term and the market's down 20%, you'll have, 94.3% of your money because you paid a 5.7% penalty, 95 basis points on the 100. And I'd rather have 95% of my money than 80%. And you can immediately turn around and either buy this again, and that's if you hold it full term, or buy the S&P with 95% of your money at a 20% discount. So you're selling, you matured at a 5% loss, and you're buying at a 20% loss or discount. And that's called arbitrage, and that's a wonderful thing. So that's probably a good segue into the next program. Ryan, any parting words to dovetail off before we go to Midland? Go back, Greg.
I think one of the things to keep in mind, one thing to keep in mind, you know, when we talk about the fee, it's only a cost in the absence of value, as the old adage says. And like Tom mentioned, that we go out and we buy the extra options. The reason that's significant is, and the reason why it ties into this slide right here, is 95% of everything else in the space doesn't have a fee, but they're also capped, which means they limit how much your upside is. And they also don't give you 135%. They're only giving you 100%. So they're capping you out. So don't look at the fee as a negative. This is actually a huge positive to have a fee on this product. I think the other thing to keep in mind when it comes to dividends, once the S&P is up over, I believe the number is 84, 85%, the return with the 135% is actually higher than the S&P with the dividend. So roughly 45% of the time, you're going to outperform even with what the dividend historically is, not even what it currently is. So with that, Tom, I'll hand it back over to you, and I will be here for the Q&A at the end.
Okay, Ryan, thank you for being here again. We truly appreciate you. Okay, so let's head on over to the next slide that you've seen a sneak preview of. And this is a product that we're revisiting that is of a bellwether flagship of Somerset at this point in time. These companies, what's great about our firm, in my opinion, I'm going to say that I founded it 25 years ago or so, been in the business for 31 years. We have the flexibility, the latitude, the agility, the nimbleness to be able to invest with or choose from among the very best products in the industry available at any given time. There's about plus or minus 865 or so insurance companies. When I got in the business in 1990, there were over 2,000. Through mergers and acquisitions and not failures, some, but not many, relatively speaking, certainly relative to banks, and no losses, touch wood. To the best of my knowledge, nobody's ever lost any money within the general accounts of any insurance company in over 200 years. And there's an asterisk next to that. If somebody knows Executive Life of New York, they might be getting slightly lower payments now on their pensions if they're still alive when they were annuitized in 1991 when the company failed. So a safe place to invest. And it being the insurance industry or with the insurance companies, and with this particular product right here, we would say that, you know, if this was Top Gun, this is the best of the best, as is the next product, as is the Athene Amplify. They're all phenomenal, and depending upon your level of comfort, you may decide, hey, I don't want any risk, okay? I can't even tolerate 20% downside risk. Well, if you can't tolerate any risk, well, for Pete's sake, God's sake, whatever sake you want to choose, please don't put your money in a CD. It's the same as putting it in a drawer plus 60 basis points minus the 5+ that we're seeing in inflation. Will inflation level off like the Fed says it's going to? I'm a huge fan of Kathy Wood. She thinks it's going to go negative. But you have to diversify. You have to be hedged. You have to protect yourself. And this is a way to benefit when the market goes up or the market goes down. Everybody's had a chance to read the screen. I'm not going to look at every bullet point. It will slow me down and my heart might stop because, as you can tell, I have a little bit of energy. So the point here is that market goes up, boom. You get 170 to 180% participation on two great indexes, the Standard & Poor's Mark V and the Fidelity MFY Multi-Factor Yield Index. Market goes up 10 over the next 2 years, 5 and 5. Those are modest returns for a low volatility index, okay? That means that you take that 10% gain, you multiply it by an average of 175. Don't even need my calculator to find the halfway point between 170 and 180. Now you're up 17.5%. You have to pay the strategy fee on this is 1%. You back out 2 because you did this over 2 years. Now you're at 15.5. Divide that by 2, you're at 7.75. Where are you going to get 7.75? Said slightly differently, 12 years of interest in a 1-year CD, or 7.5 years of interest in a 5-year CD. 5-year CDs, go to bankrate.com after the call. You'll see CDs, 5 years, top ones. Yeah, I looked a week ago, 1.1 for 5 years, 70 basis points. Top one was 70 basis points. And I shared with you that my client that had just was offered a renewal at 0.65, down from 260 a year ago on his 1-year CD. So with these products, and bottom line, market goes up, you're going to make money. What happens when the market goes down? Who cares? You'll celebrate with this type of a product. With Athene Amplify, you're protected on the first 20%, okay? Let's assume that the market goes down 20% with one of these products. Actually, I'm going to save that story. Greg, will you hit the next slide, please? Thank you. And go one more. By the way, anybody who wants one of these illustrations, just call the company. We'll run them, and you'll be able to see for yourself how these are illustrating. Okay, so here's what we're looking at here. The same 180 and 170 that I mentioned a moment ago. You've got the strategy fee over to the right of that, and you've got a mauve and pink chart here, and it's split 50-50. We get into a little bit more complex diversification than just 50-50. I don't want to muddy the waters further than I would normally do it, but we're going to put half the money in 1 year in 1 year indexes, and then half in these. After 12 months, we're going to switch the 1 year options to these 2 year options. Then 50% of your money is going to be coming due every single year. So it takes the wonkiness out of it. It gives you better historical performance, and you're going to like seeing your returns more often than less frequently. And that's one of the things that Ryan touched on, is that you have an interim value with the Athene Amplify. You can see the close every single day when you log on to your account. With these, you actually have to go look up the index and see how well they did on the day. Now, if you have them saved as favorites, and if you really care to do that, then you can do it. We don't want you doing that. We want you out spending time with your family, not looking at these computers. We want you to have peace of mind through financial independence. We want you to set it and forget it. Rest in peace, Ron Popeil, who passed away a month or so ago. That is what you want. You want to leave this stuff alone. You want to tick off the things on your bucket list. And God forbid, one of the items on your bucket list is to watch the stock market every single day. God help you there. So next slide, please, Greg. All righty, let's see what we've got going on here. So most recent, highest and lowest. Most recent is through the end of last year, the most recently completed year, through 12/31/2020. And the high number over on the left-hand side, you've got 929. That's before the strategy fee, and the 837 is the net back-tested historical performance of these two indexes blended together. Okay, and again, that strategy fee is not their profit. If you want to oversimplify what insurance companies do, they invest your money in investment-grade bonds. That's primarily where their money is. And then let's just say that the average return on their general accounts, of which these are part of, these are not sold by prospectus, they are not separate, they are part of the general accounts. We need to rely on the safety and the underlying claims paying ability of these insurance companies to be there after we've made our gains. But if you say that it's earning 5.5, and let's just assume that the total expenses and the reasonable profits of the insurance company are a total of 2.5. The difference between those two numbers is 3. The difference between 2.5 and 5.5 is 3%. That 3% they can offer you as a fixed annuity for the next 5 or 10 years. Okay, that's still 3 times better than a CD. That's great, relatively speaking, but or they can take that 3% and they can buy options on a participating index. That's what a fixed indexed annuity does. Market goes up, they exercise them, you make money. Market goes down, they expire worthless, you still have your principal, okay? So you can take that 3% and you can buy the index, or you can combine that 3% with the 1% that you're paying, that's 4%, that's 33% more horsepower, and that's upgrading from the Mustang 6-cylinder motor to the Mustang V8, maybe even the Shelby, but probably not quite that big. Pretty awesome. Okay, so the most recent is right there. The highest, I don't like to talk about because we're going back 20 years. We're looking at the first 10 years. That's one 10-year period. We drop off the first month 10 years ago or 20 years ago, and we add the 121st month, which is also a January. That's 2 10-year periods. And we crawl all the way up to the end of last year. We have 120 10-year periods, and the highest one was 10.92 on this particular program, okay? Or pardon me, 10.82. Now, that if this was a marathon of 120 runners, that's the winner, okay? So probably the Nigerian. So lowest, the lowest is the 120th finisher, 6.55. Now, I don't think anybody would complain about earning 6.55% net after expenses in an investment that has no market risk and near zero credit risk, meaning, touch wood, nobody's ever lost any money within the confines of the general accounts of any insurance company. Have they failed? Yes. I was there when it happened. I saw it. I started in the business when a bunch of them were failing. Junk bonds and junk real estate. Our previous president had a negative net worth of $500 or $600 million, and it recovered. These insurance companies got gobbled up by big companies that got bigger because of buying up companies at a discount. MetLife, Prudential, you name it. I mean, I viewed them like buzzards with a bottle of ketchup under their wing on a post waiting for something to drop. And that's how they grew. And that's okay because there was a backstop called the State Guarantee Fund that helped to facilitate all of that. Okay. So anyway, 6.55%. That is an amazing worst case scenario, historically speaking, okay, back tested. And that's why we diversify, because nobody knows what the future is going to bring, but uncertainty creates opportunity. Greg, can we go to the next one, please, here? So that's enough on Midland. I'm going to introduce this product here, American Equity Asset Shield. I've worked with this company for over 2 decades, off and on. Again, they have to continue to earn our business. We don't care about wholesalers and people, sorry, Ryan, people that are willing to buy us lunch or whatever. We're not going to be bought. We work for you, the customer, the client. And if you're happy, we're happy, because we're going to get repeat business. We're going to get referrals, and we're all going to benefit from that. So we'll leave this slide up for a moment while I talk about this product. These participation rates are even higher than Midland, okay? They introduced the 2 indexes that I'm going to cover here momentarily earlier this year into this program. They weren't new. They were just new to American Equity, which is a great American insurance company. You go to their conferences, they end with Lee Greenwood, proud to be an American. There's not a dry eye in the house. And we like them a lot. This Asset Shield product's been out for several years. And again, if there's a better product out there, that's where our flow goes, okay? Right now, these guys have the best fixed indexed annuity lineup that we're aware of, and we're aware of just about everything in this space. And if anybody thinks they know something better, we'd love to hear about it, but I don't think that's going to happen. And we're that confident. So with this particular program, by the way, these products are stripped out. You're not buying this for a guaranteed lifetime income benefit. You don't need it in these products. You have 100% guaranteed downside protection. Why do you need a roll cage and a fire suit, airbags, shoulder harness, seat belts in a car that goes 20 miles an hour on the Utah salt flats when there's nothing to run into? It's overkill. You do not need it. Okay, so you're paying for it. They'll charge you 100 basis points, and they will clip the wings, of whatever indexes you're investing in. So you're truly buying it as a DIA, deferred immediate annuity, and it's usually better than the immediate annuities that are out there that are completely inflexible, and you still maintain control. But I would use this and the Midland as cash flow vehicles. You wait a year, you have dial-o check, set up systematic withdrawals. You can adjust your income as you need to, decide how much you want to pay in taxes, because each withdrawal generates a 1099. If these programs do what they're supposed to do, meaning that they grew, you made money on your investment. That's assuming a non-qualified investment, of course. Qualified, totally taxable, and these products are great for IRAs, for Roths, for non-qualified. Doesn't matter. What matters is that you want to protect your downside. You don't want to be within 10 years of your retirement or in retirement and then have to worry about what is going to, the market going down. What happens, okay? So the equity markets are the best hedge against inflation historically by a huge margin, like 2 to 1 over real estate, okay? So you have to have participation in that. Greg, hit the next slide, please. Excuse me. Okay, so hopefully everybody can read that. You see a 50-50 allocation, two other light colors, and light green, light purple. That may be lilac. I'm not certain. So anyway, we've got Credit Suisse Tech Edge, 2-year point-to-point, 3% fee, participation 210%. You need to divide the 3.5. They're just showing it as the total fee for the 2-year period. It's 1.5% a year, so it's 50% more expensive, but guess what you get with that? 50% more options. So instead of having 3% in the fixed annuity or 3% to buy options with an index annuity, with this one, you have 4.5%. You have 50% more horsepower. Now we're actually going up to the Shelby motor, 700 horsepower in that Mustang. And by the way, I'm a Tesla guy, but I love what we're doing with a lot of our muscle cars there. So the next one is the SG, that stands for Soc Gen, Societe Generale. These are both international companies, as you recognize, on these indexes. And why? Because they've been doing it a lot longer than us over there, a lot longer, decades longer. They understood it before we did, and we're way late to the party, but it's not too late for you as long as you contact us at Somerset. So that one is called the sentiment, the Global Sentiment Index. And so let's see what it does. Let's look under the hood and check out the specs on it. So next slide, please, Greg. This is covering the Credit Suisse Tech Edge, 2-year point-to-point, as you can see at the top. This one's broken out separately. Midland melded those two indexes together and shared the performance with you. These are shared independent of one another. The best performance, again, I don't want to talk about that. That was the winner of the marathon. The most recent on the right, you can see 1265, back-tested numbers. And that's amazing. I don't know how else to say it. Not saying it's going to do it again anytime soon, but remember, if the market goes down 2 years in a row, well, I'll talk about that here in just about 30 seconds. Look at the worst case number here, or the worst number over the 120 periods is 9.2. And then, Greg, if you could go to the next slide, please. These numbers are even better. This is the SG Global Sentiment Index. Best number, look at that, 16.55. The most recent, 1289. And the worst, 1194. If you average the two worst case numbers, the 920 and the 1194, is 1057, believe. So you got a 10.57% historical worst case. I'm not saying that's ever going to repeat itself. I'm not saying that this, whatever you do now, wouldn't end up being number, 121 or worse. But what we are saying that taking these par rates, taking these strategy fees of 1.5%, the par rates of 210%, this is what it back tests at. Okay, so amazing numbers. Now, let me give you just something to consider. Markets are high. I already went over it. We've got stocks all-time high. Again, with the exception of this month, worst October or worst September since, hope that wasn't a Freudian slip, but worst September since sometime back in 2020. I think we know when that date was. But you've got stock markets all-time high, real estate all-time high, bonds at all-time highs because the yields are so compressed and low. No space between the coils. And then you've got cash paying nothing. You've got precious metals not at all-time highs, because if you go back on gold 20 or so years, the price was the same. But when it dipped, it's gone up a lot. It's gone up from 300 to 1900. It's gone up a lot. But so those are at more intermediate term all-time highs or highs. And then you've got this new category called crypto and blockchain, and that's a conversation for another day, but we'd love to talk to you about it at Somerset if you want to call us on it. But you need to be diversified. So here's an example. Market, back to this, goes down 10%. each of the next 2 years. Highly feasible, highly feasible. And by the way, the more the market goes down in these products, the better off you are, because even if the market goes down 3%, you still have 97% of your money, whether it goes down 3% or 30%. So in my example, $1 million, market goes down 10% a year. In the real world, you're at $800,000, 800, okay? In this product, you're at 970,000. Okay. Now let's envision and imagine market goes up. And by the way, when the market goes down 20, how much does it need to go up in order to get back to 100%? It has to go up 25% in order to get back to even. Okay. And if the market goes down 50%, as it did back in 08 and 09, well, guess what? It has to go up 100% in order to get back to even. Okay, so with this, I'm just assuming the market goes down 10% a year with this product over the next 2 years. And then I'm assuming over the following 2 years, it goes up, back up 25%. So now in the real world, your million got back to $1 million. In this product, you'd have $970,000 buying those options, assuming the same 210% participation and the same 1.5% fee, okay? The market went up 25%. Multiply the 25 by 210, that's 52.5%. Deduct the 3% fee, that's 49.5%. Apply 49.5% to 97% of your money, or $970,000. You're now at $1,450,000. You made 45% while everybody else was just breaking even with no risk. Asterisk. Subject to the underlying claims paying ability of American Equity. Pretty amazing. So that's, I think that's just about a wrap. So anybody who has questions on these products, would like to receive illustrations or all the literature, it can all be emailed. It can all be emailed. Easy peasy. And by the way, you can just Google this information. It comes up left, right, and center. You can Google these indexes. They're going to come right up. You're going to be able to track them. Okay, you can find them on Bloomberg. You can find them on their own indexes, and so at the end of the day, the bottom line is that we are in some incredibly uncertain times. And you know, I've had my clients talking about crazy things over the last 30 years, and I'm like, okay, yeah, and things, you know, things end up being relatively okay, and I'm not saying that this time it's different. I'm just saying that we're facing a lot of things, and it's reckless to invest in equities with all of your money. And it's just as reckless to keep your money in cash or CDs, because you're going to be eaten alive by inflation. So remember that. I always refer to it as chasing something that I'm incredibly passionate about. Also getting chased by a steamroller. Either way, I'm motivated. And I feel that everybody should view it very much the same way. So protect yourselves, self-advocate, and contact us. We'd love to help you. We'd love to help you exceed your retirement goals and be able to tick off all the things on your bucket list, as long as one of them's not watching the stock market every day. Thank you all. God bless you, and be well. Thank you. Thank you, Greg. Thank you, Ryan.
Thank you very much, Tom, and great job, Ryan and Tom. Thank you. There's no questions in the Q&A queue. So as Tom mentioned, please email us at webinar@somerset.sec.com, and we can provide you with product information, illustrations, copy of the report Tom alluded to, and any other information you might need to make a more informed and educated decision. Thank you for attending. Have a great day.